Good morning, everybody. Welcome to the second breakout session. This is health and sickness, as you're aware. My name is Paul Chait. I'm the director at FiscalReps, and this is Christophe Boudet, who's a senior manager of the company as well. Christophe also specialises in French-speaking countries in Europe, so France, Belgium, Luxembourg. What we thought we'd do this forum is to basically look at different insurance products as opposed to the countries themselves. Before, in the past, we looked at individual countries and explored the different premium tax regimes there. What we're going to do this time is just look at a product and explore the trends and the differences with those particular products and how it impacts on the IPT. What we'd like to do is make these sessions as interactive as possible, so if you have any questions or any comments, please ask those. So what we've done this morning is we're going to break it up into three sections. We're going to have the first section, which is just looking at the industry and the definitions around sickness, health, and accident, which also falls into these type of products. The second side, sorry, where's the view? Oops. Yes. The second section is in relation to IPT. What we'd like to do is to look at the location of risk rules. What we're going to do over the course of the morning is to look at general insurance and look at long-term insurance. We're going to split those two products up because from an IPT perspective, they're treated differently. So if there's a bundled product, we just need to make you aware of the differences there. And then on the third section, what we'd like to do is focus on 4 different countries. So essentially the UK, Ireland, France, and Spain. And we've chosen these countries because it gives you a different insight as to how the premium tax regimes will apply to this type of product in the marketplace.
So to start on presentation and introduction on sickness and health, a couple of figures. So first, in terms of part of the non-life business in Europe, you can see that health represents 25% of the non-life premium written in 2012. So in volume, it gives 113,000 million of euro of premium, so which make it an important business on the non-life, general non-life insurance. You can also see that the evolution from 2003 to 2012, where we are around 50,000 million, and now with more than 100,000 million. So we can see that the market has more than doubled over the last 10 years. So it's quite an increasing market. And also we can see that it's mostly a Western Europe market, because we have for just Netherlands and Germany that represent almost 70% of the market, plus France, Switzerland, Spain, UK, Italy. So we can see that most of the premium written on sickness and health in 2012 are mostly written on Western European countries. In terms of definition of sickness, if we refer to the first non-life directive from 1973, so first, sickness is classified as class of insurance 2 on the 18 non-life insurance classes. And it's defined as a fixed pecuniary benefit or benefits in the nature of indemnity or the combination of the two. And we will see after, we'll talk a bit about accident class of insurance, that it's often, the market is often referred to accident and health insurance. Then we have, so we're talking about the class of insurance, a non-life class of insurance, but in some specific case, sickness will fall within within life or long-term insurance. So in terms of sickness as a non-life class of insurance, we can see it mostly in 2 types of contracts, what we call the supplementary contracts, so that sickness contract that come in addition to a national health or sickness scheme, like the NHS in the UK or the Assurance Maladie in France. And then we have the comprehensive contracts that are covering all the medical fees without requiring a national health scheme. So that's sometimes referred to expatriate policies or first euro or first pound policies. On that topic, we can also match these two types of contract by the type of business. So supplementary contract will be mostly sold by domestic companies rather than comprehensive contract. We can see it on a day-to-day basis with our clients that that's a business that is sold by freedom of service companies, and they will not, on a freedom of service basis, these companies will not sell a supplementary contract. Then when we consider sickness on the long-term side, we mostly refer to countries like UK or Ireland with the class 4 of the life of the long-term insurance, which is called permanent health. So Paul will talk about it a bit later, mostly on the UK and Ireland focused. But we also experienced it in Germany recently, where basically the common sickness contract is taken out for a large period, and it's based on a tacit renewal. So basically, if you don't cancel the contract, you will renew it every year. And on that, in that sense, this can also be considered as permanent health in Germany, even if the content of the permanent health may differ from UK and Ireland. What we would like to highlight here is, with our experience with our clients on sickness and also accident, the kind of issues of situation that we face with our clients. The first one will be we often think about sickness insurance as an individual insurance, but sometimes it can also be taken out by a company, and we will see after on the location of risk side that it has some consequences, because depending if you are if the insurer taker is a company or private individual, the location of risk may differ. Then we have the situation where we have an insurance product that will cover different risks, one of them being sickness or health. The best example in that is travel insurance, where you can have accident, sickness, assistance. You can even have sometimes motor included. And we can see that depending on the countries, in terms of consolidating your compliance, you need to focus on the countryside here, because some countries will consider travel as a single class of insurance, referring to the non-life class of insurance. Travel insurance falls within class 18, but other countries such as Spain will consider that travel insurance needs to be split by covers, and in that case, in terms of IPT application, of tax application, you need to consider each cover, and you will most of the time have different IPT rate, and even if we talk about Spain, extraordinary risk surcharge that apply. Another situation is the taxation of the permanent health in countries that do not recognize this class of business. That's the case we had in France recently, where we had some German policyholders that have taken out what was referred as a permanent health contract in Germany, and coming to France, that do not recognize that class of business. This permanent health contract became more a health contract. So from a life or long-term contract, we switch to a non-life contract. So also we have implication in terms of tax and IPT application.
This is sorry.
Yes.
This is an interesting area for us. We moved into life assurance last year as a result of the CCJ case I'll talk about in a minute. Essentially, what we've recognised when we're talking to tax authorities and the regulators is that certain long-term classes of insurance, so just to recap, there are 9 long-term classes of insurance, one of which is permanent health. Not all of these, even though it's based in an EU directive, not all of these are recognised by each of the EU countries. So, for example, you may have a UK company running permanent health insurance into France. That product isn't recognised in that particular country. There may be similar products, but as a class of insurance, it's not as such recognised. And that has some implications on the IPT aspect as well. Ordinarily, you think those type of products are exempt, but because they don't fit into the IPT legislation in a certain way, a taxable policy may result from that.
Last point, last situation, and it's quite fresh news, or the hot topic in France at the moment is the CMU tax. You may have received a letter. I would say the timing is perfect because the fund responsible of the CMU tax has sent letter to most of the freedom of service companies last week. So as a freedom of service company writing business in France and authorized to write class 2 of insurance, of non-life insurance, you have probably received a letter at the beginning of this week related to that tax, which is a parafiscal tax which is due on specific sickness contract. And this is a topic that I will develop in the focus on France. In terms of sickness and health, so as mentioned before, accident is often linked or added to the health to form this accident and health business. And we can see that accident is obviously a smaller market than health, but added together, yeah, it represents 1/3 of the non-life insurance business in Europe. In terms of country, as it was the case for health, we can see that the 3 top countries, France, Germany, Netherlands, and then we find the same one, Italy, Switzerland, UK, Spain. So we can see also that accident as well as health is a Western European market. Accident, in terms of definition, so that's a fixed, according to the non-life directive of 1973, fixed pecuniary benefits in the nature of indemnity, combination of the two, and injury to passengers in the case of motor insurance. But here we also have an industry definition which is interesting because it introduces the fact that you can refer as accident as a non-life class of insurance or life class of insurance, because it's defined as the coverage for bodily injured and or deaths resulting from accidental means other than natural causes. We can see in lots of countries life insurance products that include an accident cover. So main case would be life insurance, and with a cover we have the example in France where you can have the beneficiary can have the capital doubled if the person that took out the life contract died from an accidental cause. And in that case, in terms of IPT application, here we are more the first thought would be to apply exemption, but in that case, accident will fall within non-life insurance, and there will be the necessity of splitting the premium between the life premium and the accident premium, and apply the correct IPT rate. In the case of France, exemption on life, but the accident cover would be taxed at 9%, the default IPT rate in France. And lastly, for accidents, sometimes the accident covers the loss of income, and in that case can fall within miscellaneous financial loss, which is class 16 of non-life insurance, And we can see in some countries like Austria that the tax application, whether you consider something as accident or miscellaneous financial losses, the tax application would be different. For accident, you would consider it as 4% IPT, rather than class 16 would attract 11% IPT. So very important to know on this type of product what really covers, what the contract really covers, because you have implication in terms of tax application.
That's right. So if you've had a bundled product with a number of different classes in there with different IPT rates, then it's important to apportion that premium from an IPT perspective, so you're paying the right amount of IPT in that particular country. So that's essentially why we're going through this area of looking at the individual classes.
And lastly, we wanted to mention care, which is also included sometimes in sickness or accident product. And care is most of the time exempt from IPT. But sometimes care can also be considered as loss of income or a revenue provided to compensate person that have long-term disability. So then again, needs to go into the detail of the product to see if it in which category it falls. So we already mentioned it, but yeah, the main idea here is that when you have a multi-risk contract, should you split or should you not split the premium? And here we are looking on the country by country tax application. Some country, we take the example of travel assistance, will consider this as class 18 and apply the IPT rate for class 18. Other will split between class 1, 2, 16, 3 sometimes, and apply the relevant IPT rates.
So that's a quick fly past on the regulatory side. If we look at the location of risk, the reason we want to bring this to your attention is that when you're looking at health products, they can either be written as general insurance class 2, or they can be written as long-term insurance class 4, it's permanent health insurance, or these products can be bundled together. As I mentioned before, there's a subtle difference between the location of risk rules that insurance companies need to be aware of, so they're paying the right taxes in the right country. So with regard to general insurance, we've got the second on-life directive. Article 2D is the Bible with regard to this. 4 indents. If I may just go through each of those 4 indents. The first relates to property, so wherever property is located, or the contents, that's the location risk for that particular policy. By contents, we mean household contents, plant, machinery, that type of thing. With regard to the second indent, we're looking at vehicles of any kind. Tax authorities generally interpret that as being aircraft, shipping, and land vehicles. With regard to the third indent, that's looking at holiday and travel policies of a duration of less than 4 months. And then lastly, if your product doesn't fall into either of those 3 indents, then you're looking at the 4th indent. And that in turn is divided into 2 parts. If you're looking at a policy that is taken out in respect of an individual, we're looking at where the individual habitually resides. If it's in relation to a group policy, if a group's taking out a health insurance policy on behalf of its employees, then we're looking at where that establishment's located. The key term here in terms of individual policies is habitual residence, because it's not consistent from one country to another. For example, in the UK, if you live in the UK for 12 months or longer than 12 months, you're habitually resident in our country. In Spain, it's only 6 months. So in terms of the location of risk rules, you need to be aware of those nuances in terms of being compliant. With regard to ECJ cases, these are important because they set a precedent across the whole of Europe. Just to sort of recap, we've got 95 individual premium taxes in Europe. Each have their own legislation, tax authority guidance, case law. They do their own thing basically, but the ECJ rules, the findings will apply across the whole of the community. And some 10, 15 years ago we had the Governa case. That basically was a wake-up call to general insurance companies, because in the late 90s, effectively, if you had a European policy, insurance companies would be, if it was a UK insurance company, they would apply UK IPT. They wouldn't be drilling down into the individual countries where overseas premium taxes could apply. So thereafter, corporate governance delivered guidelines, procedures for insurance companies to be compliant, and that's what we see today. Then on the 21st of February last year, we had the RVS case, which was a local dispute between Dutch insurance companies and the Belgian IPT authorities. And effectively it's a bun fight over a small amount of money. We think it's only 5,000 euros that was at stake in this particular case, but as a result of that, it set a precedent across the whole of Europe, which is now making it difficult for life insurance companies. What happened? Essentially, we've got Dutch resident individuals who have taken out a life policy with a Dutch insurance company. In Holland, the IPT regime is exempt. But over a period of years, those individuals then crossed the border into Belgium, and they became habitually resident in Belgium. So any payments made from Belgium, the Belgian IPT authorities thought that their IPT regime, which is 1.1% of the time, should apply to those payments. Big dispute, or small dispute, escalated to the ECJ, and effectively we're looking at two interpretations. We've got the static interpretation that's looking at where the contract was taken out by the policyholder, which is effectively that Dutch model. Then we've got the dynamic interpretation, which is what the Belgian IPT authorities will argue, which is if you're habitually resident in their country and you're paying the premium from their country, their IPT regime will apply. The Advocate General, a lady called Colcott, passed an opinion, and she'd been 100% right in her opinion right up until this particular case. Her opinion was disregarded by the court. It came as a huge surprise to everybody as a result of that. And as such, the implications of this case is that insurance companies, or life insurance companies, now have the administrative burden of tracking individual policyholders across Europe. So if you can imagine a UK life insurer, if your policyholder retires in Portugal or Spain, all of a sudden you now have to consider the premium tax regimes in those countries if you want to be compliant. There's also the pricing aspect to consider as well, because the insurance companies now have to build into what was essentially an exempt IPT regime in many countries. They have to build in the overseas premium tax rates into their premiums, so they're going to be operating a profit. Potentially there's interest and penalty charges, then you have declarations in those particular countries, which is another aside. But effectively this has caused, I would say, quite a big problem in the life insurance market, essentially. And what we're seeing now is a bit of a catch-up in terms of life insurance trying to be corporate, in terms of meeting their corporate governance obligations. So that's the individual side. With regard to group cover, where a policyholder takes out cover on behalf of its employees, we're left in the dark because the ECJ didn't cover all aspects. We're now speculating as to what should happen. So we spoke to the Belgian IPT authorities, thinking that the most likely port of call, and asked them that very question, and their answer was that the location of risk is where the company, where the policyholder is established, i.e. the company that took out the group policy. We fear that it could be the individual employees that are moving across Europe, but it wasn't. It was where the establishment was. But we have to caveat that because we've got 95 different tax authorities. They're each going to have their own different interpretation on this particular ECJ finding, where it's not explicit as to what the rules are. So that's the area that we are in regard to location and risk. So it could be that if an insurance company is writing a bundled product of Class 2 general insurance and Class 4 long-term insurance, you may have two different locations of risk for the same policyholder. So what we'd like to do now, we overran last time, so we'll try and speed this up. We'd like to look at 4 countries, as I said before, just to demonstrate the different type of rules that apply to this type of product in the marketplace. If we start with the UK, what I'd like to do is just make again that distinction between general and long-term insurance. So in the UK, health and sickness is subject to 6% IPT. That's the current IPT rate. If it's part of a travel policy, then the higher IPT rate of 20% would apply. Likewise, with accident, there's an exemption applicable to crew, passengers, and ships, which doesn't apply here. With regard to long-term insurance, Essentially, the UK IPT regime says that this is exempt. However, in 1997, we're going back a few years now, in 1997 there was an IPT case which was called the Manchester and Salford Hospital Saturday Fund. And effectively, this was 3 years after the IPT regime had been introduced in the UK. What we saw here was that insurers were trying to be clever and basically categorise Class 2 insurance as long-term insurance and treat it as exempt. Customs and Excise weren't particularly keen on this. It went to case law, and then the IPT legislation was updated with regard to this new anti-avoidance legislation. What I'd just like to bring to your attention is what is the definition of permanent health insurance. It's quite key here because now we're looking at characteristics as to what will give you an exemption and what becomes taxable. So the definition we have here is that policies that provide for payments if the insured person becomes incapacitated as a result of injury or illness. The policy must provide cover, and this is an essential wording here, for at least 5 years or until normal retirement age. So that's a distinguishing factor from general insurance of the insured person, although it's possible to provide cover without a time limit. The second key piece of wording here is that the insurer cannot terminate the policy unless the policy wording specifically provides for a termination in certain circumstances. So if your medical insurance meets these criteria, these characteristics of long-term insurance, the exemption will apply. What the anti-avoidance legislation said, and what was inserted into the Finance Act 94, was that all insurance that provides cover for private medical, dental, and optical-related treatments typically offered through private medical insurance or hospital cash plan insurance is going to be taxable. So you just need to understand the characteristics of the product you're selling here. That's not to say that all permanent health insurance is taxable. There's going to be very specific products in the marketplace where exemption will apply. There's going to be critical illness cover, there's going to be permanent health insurance, and there's also going to be any insurance that relates to care or convalescing. So you think it's straightforward in the UK, but you've just got to be mindful of that old IPT case.
So in France, it's also not straightforward. We have two main topics in France in terms of sickness. First the IPT side, and then the parafiscal side, which is mostly the CMU tax. In terms of IPT, the French market make the distinction between two types of contract. Contracts that are called solidaires, solidaire contract, and non-solidaire contract. Basically, a solidaire contract is a sickness contract where the insurer doesn't ask any information, medical information about the insured in order to bill the premium. So, for instance, a contract where the insurer will ask if the person is a smoker, has cancer antecedent, history in the family of heart disease, or this type of information. The premium then will be built on that type of information and on the risk that the insured person have of I would say dying early. In that sense, this contract would be considered as non-solidaire contract, at the difference of the other solidaire contract that will be a kind of default contract where no information of the policyholder is asked and a basic premium is sold. So in France, 90% of the insurance contracts are deemed to be solidaire and 10% non-solidaire. That's mostly the split. In terms of IPT application, that's where it becomes interesting. Solidaire contract, if we go back to 2010, used to be exempt from IPT. And non-solidaire contract would attract 7% IPT. And then in 2011, with a tough economic situation, the government at that time was looking for some ways to reduce the deficit, the budget deficit, and increase the rates. So basically, the Solidaire contract switched from an exemption to a 3.5% IPT rate. This lasted for 10 months, and in October of the same year, the Solidaire IPT rate switched to 7%, which was in line with the non-Solidaire contract. Therefore, at the same time, the non-Solidaire contract IPT rate changed from 7% to 9% in order to still show the different tax application between these two types of contracts. Then came 2012 and the presidential elections in France. And the socialist candidate at that time, François Hollande, which is now the president, in his manifesto committed to go back to the exemption on the Solidaire contract. What is the situation today? Situation today is Solidaire contracts are still at 7%, and non-Solidaire contracts have increased from 9% to 14%. So, as Mike mentioned in his introduction this morning, tax is often politics. Here we have a clear case of politics in the sense that the tax authorities for presidential, for elections and getting an election win, there is a commitment to make an exemption, and in practice you don't have an exemption, but in fact you have exactly the same situation that we are back in 2010 with a 7% IPT difference between the two types of contract, because we have the contract at 7 and 14%. So this is how it is now. What we anticipate is, as it was the case for the previous presidential campaign, in 2017 maybe the same promise of exempting the Solidaire contract would come back on the pretendant manifestos, because it's a good way of trying to win votes, but we will see in the next 2 years. In terms of the second topic, which is the parafiscal taxes, I'm talking here about the CMU tax, which is an IPT note. It's an additional tax of 6.27%, and this tax is due on specific contracts. As I mentioned in the introduction, it's due on the supplementary contract that come in addition to the French national scheme, which means that in terms of business for freedom of service companies, when you will write sickness business in France, you will mostly write comprehensive contracts, first euro or expatriate contracts, and this type of contract fall outside the scope of the CMU tax. But I believe you all received a letter at the beginning of the week on that topic. So the position now at the moment is that basically the CMU fund look at the regulator website and look at all the freedom of service companies that are authorized to write Class 2 sickness insurance in France, and send that letter considering that there may be some taxes to collect here. So they send the letter and requesting to the client, the companies that think they may have some liabilities to declare, to disclose the liabilities, and to start a registration process, and then an ongoing compliance process. At the moment, as far as our clients are concerned, lots of them are authorized to write Class 2. It doesn't mean that they are actively writing this type of business. So if you are not writing Class 2 in France, or if you are writing Class 2 in France but contract that fall outside the scope of the CMU tax, for the moment you can disregard this query from the tax authority. But we understand that in the future the tax authority may require companies that are authorized to write Class 2 to register for that tax, which in terms of compliance will add to the French burden, because that will basically mean that you will have to register just to file nil returns, because that specific tax, the CMU fund, require nil returns every period. For clarity, the tax is filed on a quarterly basis. So this is the last update on fronts on sickness. We can switch to Ireland.
The reason we chose Ireland is that, again, making that distinction between general and long-term business, we've got separate premium tax regimes for both. So with regard to the general business, we've got 4 premium taxes that will apply. There'll be the stamp duty, which is €1 per contract. There's going to be the government levy. We're going to have the compensation levy, and then it's going to be the health levy. With regard to the government and the compensation levy, there's exemptions which cross-reference, and this is something that we see a lot with long-term policies. We cross-reference into other legislations to give us those exemptions. That's the Health Insurance Act 1994. The health insurance levy is 1%. It's an insurer tax. In other words, it's an insurer-borne tax, and that's essentially based on the duration of policy, the age of the person, and also not being kicked out. The age of the person, duration of policy, and the type of cover that's been provided as well. So 4 premium taxes apply to general insurance. Then with regard to the long-term insurance, we just have 1 premium tax, and that's the insurance, Irish insurance levy, and that's 1% on the permanent health insurance.
So now switching to Spain, wanted to make a focus on Spain because Spain is considered a very difficult country in terms of IPT compliance, if not the most difficult country in Europe. And actually for sickness, it's not that difficult. There is an IPT exemption, but still there are some parafiscal taxes. So namely, if we're talking about sickness, you will still have the winding up activity contribution to declare. And when it's about accident, you also have the extraordinary surcharge that are due on this type of business. So even though on the IPT side, it's quite straightforward, in terms of parafiscal charges, there are still compliance work to do on Spain. And I think from Spain we can also switch to Portugal because we have some latest development in Portugal. Portugal usually, sickness in Portugal and accident, they normally attract parafiscal taxes called INEM, and the current rate is 2%, but we understand that in the budget project for 2015, an increase to 2.5% has been introduced. So the budget is currently being reviewed, being voted. And so far, we don't know if this increase is going to be accepted. What we know from experience with Portugal is the budget for the next year, which is supposed to be voted by the end of the previous year, can in fact finally be voted in February or March of the same year, which in terms of compliance here adds some issues because you could have to retroactively apply an increase on the premium of the first months of the year. But obviously, this is still in discussion at the Portuguese Parliament. So any confirmation or any update on that, we will provide any information through our tax alert or next newsletters.
So in summary, we've just covered the regulatory side, how that impacts onto the premium tax regime. We've looked at the location risk and drilled down to different countries where those premium taxes should be paid as a result of location risk rules. Apologies, we have run out of time. If you have any questions, please feel free to ask us those questions now or during the breaks. We'd be more than happy to answer those. I guess you deserve your coffees now, so thank you very much.